Welcome back to the Dividend Diplomats YouTube channel. You've got your favorite dividend investors out here in all of social media. Bert and Lanny, guys, over 20,000 subscribers. Make sure to hit that subscribe button. And over 30 plus thousand followers over on X and Twitter. Rock with us, guys. Let's get to financial freedom because here are two stock. One stock that's down 21% in the last 52 weeks and another stock that is a growth stock down over 10% this year. And is it too cheap for me to ignore it?
Smash that subscribe button. Give this video a thumbs up. Join the Diplomaniacs out there. Let's go, everybody. We have two stocks that are too cheap to ignore. Can't wait to jump right in and evaluate these two dividend stocks.
Funny. One's a monster of a stock and one is smaller. One has a market cap of trillions. The other one has a market cap of just billions, but of the same number. So
one eats the other one for breakfast.
yeah, it's it's the bowl or the cup. Which type of soup are you looking for, or is it no soup for you? Seinfeld style, guys. But here we are. We're filming this again here, March 2nd, 7:48 p.m. Eastern at night. The pricing is going to be as of February 28th. You guys have watched plenty of videos, hopefully this year, and have seen the list of Bert's and even my list of the 5 to 7 stocks I'm looking to sell. Some that pay a dividend, some that pay no dividend, some that pay but don't necessarily increase their dividend. So I'm looking to, get some capital from selling out of positions. Yes, selling as a dividend investor, it can and does happen when it doesn't fit the dividend growth, keyword dividend and growth strategy. And, this first stock, it's made plenty of headlines this year, made plenty of headlines towards the end of last year. Again, they're down 10%. Bert's been opening up his bag and grabbing as many shares as he can every single week. I mean, we're filming this through, a Chromebook, got my Galaxy phone, pretty much use YouTube like it's nobody's business, guys. We're filming this here on there. So, Bert, let's talk about Alphabet/Google.
Ticker symbol GOOGL. Yeah, Lanny, I love it. This has been one of the most beaten down of the Mag 7 stocks. I've been buying it. I set a goal of wanting to get $5,000 invested into Google between my account and my wife's, and we were able to do so. And this is the company to me, Lanny, that it was in 150, 160, jumped up to 210, and now it's coming back down to the 170 range. And I've been grabbing it every step of the way down, grabbing one share, two shares. It seems like every $5 it drops, I'm grabbing a little bit more.
It's like, is this a gift? Is there something that we're missing here? Because, one of the most actively traded stocks in Google, it's like, who knows something that we all don't as retail investors? How is this stock trading at $170 a share? Simply because of what the earnings multiple is looking like, guys. It just doesn't make sense. I mean, they have the ability to probably cost cut and do all those things as well. Every company is doing, but yet, so much of their revenue is subscription, cloud, all of that based. Obviously, the advertising dollars. It's not like they need too much manpower behind it just to keep the revenue and earnings engine going.
I know, it's fantastic. So let's jump into that screener here. Their forward earnings are 896. Their PE ratio is 19, and their 5-year average PE ratio is closer to 25 or 26. So it's not like they're slightly below that 5-year average. They're well below that average price to earnings multiple for Google, which is absolute insanity. That's why so many people are flocking towards it right now, because it's that heavy discount.
Birds of a feather flock together, guys. But payout ratio, so they do pay a payout of 20 cents per share per quarter. We're looking forward to the first dividend increase that they hopefully will announce this year. Again, we keep making references, but Meta, aka Facebook, increased their dividend only 5% this year. But the payout ratio for Alphabet is 8.93%, one of the lowest payout ratios we have covered here on our channel.
Yeah, that yield isn't large. It's 0.47%, but any of the Mag 7, you're not going to get a high yield. You're buying them for some dividend and some dividend growth, but mostly appreciation. So that tracks with what you'd expect from Google.
Exactly. Now, again, no real 5-year yield average since they just started paying one last year. But again, down 10% this year, up still 24% from last year. So keep that in mind. But they are 2.09 trillion in market cap. And again, I've got a bunch of stocks and a bunch of duds in the portfolio, you name it. Intel is in my portfolio that I've been selling covered calls on to try to exit, but still getting premiums every single week. So turning it into a dividend play. If I can average between 4 and 8% yield on Intel from selling those, that would be great. But then there's a couple of duds in my wife's portfolio that don't pay a dividend, such as Walgreens now, as well as Master Brands Company. So there's a lot of zeros on the balance sheet.
Yeah, it's a great company. I told you, I love it right now. I think it's fantastic, and it's a great one to keep a watch on. And it is getting to that point where it's too cheap to ignore for almost everybody right now. So that was our
So
first
that's
stock today.
the first stock.
Or two. Who's number two,
They're
Larry?
all stock. So remember, Alphabet/Google was 2.09 trillion. We're now going to step into 2.7 billion market cap stock, a very small cap stock here, in our opinion. Manpower Group, ticker symbol MAN. Very easy ticker, guys. I know Bert loves it, but this stock is down 21% in the last 52 weeks. They're they've been increasing dividends for over 14 years. That we'll come to find out. The best part about Man Group is that Manpower. When you think about their business model, with recruiting and with all the other search and resources that other companies might want to outsource, they're really there to help fill that niche. And you know how much recruiting fees are, don't you, Bert?
Yes, don't tell me twice about how much recruiting fees are. I can tell you that. And I just went to their website. Here, what are their areas of expertise? Cloud infrastructure, digital workspace, cybersecurity, enterprise applications. Let me tell you where the talent's going to be flying right now. That is the hottest area. That's the hottest area to find people. So it's not as if their niche is something that's not desirable. It's where the workforce is moving and where the talent needs to be and where it's the most competitive. So they could just print out money with those recruiter fees in an area that's sought after by so many companies.
Yeah, and again, a very highly prolific and visible entity, one of the most well-known ones, actually. And let's see how their stock looks.
Yeah.
Again, trading at $57.63. We had covered them one time, probably in 2023, I want to say. Current forward EPS is looking at $3.99. So the PE is at 14.44 at the moment.
Their dividend's $3.08. It's a 77% dividend payout ratio.
Yeah, it's the one thing right now that I don't like about Manpower Group is that high dividend payout ratio. I mean, 77% is very high, especially for a smaller company and a company that, hasn't been through the thick and thin yet from a dividend standpoint. Because they've been growing dividends, not to say only, but they've done it for 14 years at an average rate of 7%. But, what's that last increase, Bert?
Last increase is 4.76%, so it was a little bit lower than the average. So it's a little bit more conservative than that last dividend increase from.
Yeah, and you kind of think with the 77% payout ratio, more than likely dividend growth, might be very, very slim, maybe in that 2 to 4% range for a year or two until they start to right size their earnings.
Yeah, and the risk you'd run into is if there is a recession and there is a slowdown. It's great and they have access to all this talent, but it also is one of the easier bills to cut. It's the fastest bill to cut. If your company's not hiring, you're not paying you don't need to hire people. This goes out the door. So that revenue can go really fast if the economy turns in another direction. So that's the risk with the 77% payout ratio.
And that's why they're down 21%, and they're paying you a 5.34% dividend yield. I will have to make a note that they paid dividends only 2 times per year versus quarterly.
Okay, but yeah, at least it's far above that 5-year average, 3.47%. Yeah, you're right. So 52 weeks down 20%. They're just hanging tight in 2025. Okay, that's Manpower. Do you have put the metrics up here, lady? Do you have like a target price point for both these companies with Google and Manpower?
Manpower is interesting because it's almost like the Leggett and Plots, Paramounts, the Kraft Heinz, the companies that do pay a dividend that I'm looking to exit, the First Energies, there's a higher yielding stock here with Manpower Group at 5.34% that can actually get you the yield back as well as the dividend growth streak that they have. Um, but I don't like this high payout ratio, so I think I'm actually just going to have to pay attention right now. It's not even really a price that I'm looking at. It's more of is are they really making only $1 EPS per share per quarter?
That's fair. So Lanny's saying, I like the company, I believe in the company, but I want to wait and see the earnings to check out what's really going on. Are they doing enough to keep that payout ratio in line, or is that problem going to get worse? I think it's a very respectable position based on all the dividend cuts we've seen over the last years. It's better to wait and see and or just pass than jump right in and then find yourself in a situation where you're stuck in a massive unrealized loss. That's exactly what you're trying to get out of.
Exactly, and I mean, again, there's always the small company, kind of stuff that you have to go through. More volatility happens with they're more, susceptible to interest rates and other economic, fluctuations faster typically, because of how much smaller the company may operate at. But again, hey, two different stocks, one a low yield stock, one a high yield stock, one that's down 10% this year, but one that's down 21% in the last 52 weeks. Um, One that's 2 trillion, one that's 2 billion in market cap. So really wanted to provide some spectrum here for everybody.
Yeah.
Like both companies, similarly, I'm going to have to figure out Google. I don't see myself adding like fresh capital to it. I see it more of, hey, where can I get capital from losers and add it to a company like Google?
Yeah, I dig it, Arian. So let us know, what do you think about Google? What do you think about Manpower? Throw it down there in that comment section below.
Yeah, guys, like this video, subscribe to this channel. Let us know what other stocks you're buying right now in 2025. How are you building your passive income stream? Let us know in the comments.
And what is one other thing we need to tell these people, Andy?
Look at you now. Guys, you're either with us or you're against us. Jack, that was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.